on the real estate industry, I think it's something that stands true in almost every market. If you undercut your assumptions on income and assume your expenses are going to be more than you really would like to, and it still makes sense, then that's a deal you want to do.
That's you're safe,
right?
Okay.
So you want to be conservative, and if you're wrong, you should be wrong to the upside, not to the downside.
Right. That's great. Let's get to a term that is known in the industry, but sometimes could be misunderstood, if perhaps that's the way. Hard money, bridge lending. What do those terms mean?
So actually, we call it smart money, not hard money.
I love that. Nice.
Thank you. And the reason is for the fact that it's quite simple. Too often people will look at a loan and they'll say, well, how much am I paying in interest rate?
Right.
And it may seem very, very high as compared to a bank, or there's origination, or whatever the other fees may be as associated with closing that loan. But in reality, what they're not looking at is the opportunity cost that's being provided or being potentially lost if they don't do this deal.
Right.
So I can buy a building that I can't finance with a bank, but I can finance with TBG Funding.
Right.
And my projected economic value that I'm going to create is, let's call it $500,000. And of that $500,000, it's going to cost me $30,000 to get the financing.
Okay.
Well, so then that brings my net bottom line to $470,000.
Right. Correct.
Great. But if I can't get the financing, how much economic value do I have?
Right. The deal's
You have
dead.
zero.
It's zero.
So would you rather make $470,000 and have the deal, or make zero and not have the deal because it was a little bit too expensive? So it's not always about the money, the absolute dollar that it costs you to get this deal done. It's about what kind of value are you creating? What kind of net worth are you creating for your portfolio? So it's a very important piece to understand that there is no difference between hard money, smart money, and bridge financing. It's all the same thing. It's there to fill a void. It's just nomenclature. And ultimately, the objective that we try to educate our borrowers is, are we bringing value to you? And our borrowers tell us that we are.
You touched on this earlier in the show, but do you provide funding for any type of business, or is it only within the real estate market?
So I would say that the overwhelming majority of our borrowers are, in fact, real estate operators, whether they be developers or fix and flip or hold and buy and hold. They're going to be overwhelmingly, their primary business will be real estate. That having been said, we certainly have had a number of clients who have come to us with businesses where they own their property and they need, for whatever reason, to access capital for a short period of time or in a very quick period of time, and we're the best solution for them. In fact, I recall one deal we did up in Massachusetts. It is a tent manufacturing company.
Okay.
And we lent on his warehouse and office space. It was a couple of acres, a building or two. And we had to underwrite the business to make sure that they had the ability to ultimately refinance out. So there would be an example of a non-real estate operator who used the real estate that he had acquired through his business for the purposes of accessing capital for his business.
So just to make sure that it's clear for the audience, it's not just when someone is buying a property, but if someone, let's say, owns a property and it's fully paid off, they own it, there's no mortgage on it anymore, they want to invest in something else.
Or even if they do have a mortgage. Very often somebody would buy a property or it's been in the family for many, many years, and they took a mortgage 12 years ago, and it's got 3 years left, but the principal balance is very low,
down,
and there's a tremendous amount of equity, and they'd like to access that equity. So we will refinance them out of that and give them additional cash out equity, and then they'll go, at their leisure and find conventional financing.
What's this next question goes at the core of your strength. What's the length of time that a deal from when someone calls into the office that they're looking at everything moving into high speed and that they can actually get their funds?
So I've often been asked that question, and it's a good question, and it's a fair question. And the answer, I'll give it to you in a moment, but I must say that there's a tremendous dependency on the speed at which the client can move. because we are in our underwriting process going to be requesting information and documentation from the borrower.
At rapid speed.
At very rapid speed. Assuming that is responded to and we get what we've requested, we can close the loan in as little as 7 days. We've done it in less.
You've done... So,
we've actually closed the loan.
Fast.
Our quickest loan close ever was a property that we knew prior to the borrower coming to us. But from the time he walked in the office till the time we closed was actually 24 hours. I don't like to say that because that sets an expectation that's unreasonable. But there have been multiple loans that have been closed inside of 3 days. And as I said, typically 7 days is a very, very doable number.
I always love asking my guests a final takeaway, that they could share with the listeners. But in your case, I'd love to ask perhaps two final takeaways. One that has to do with the real estate world, the funding world, and perhaps one because of your knowledge, like you said, you're exposed to so much. You have a wealth of knowledge of where things are heading because when deals come to you, you do all that due diligence, you do all that research. So whether it's office space, malls, etc. So perhaps you could share a takeaway on the real estate industry and just business in general.
So on the real estate industry, I think it's something that stands true in almost every market. If you undercut your assumptions on income and assume your expenses are going to be more than you really would like to, and it still makes sense, then that's a deal you want to do.
You're safe,
right?
Okay.
So you want to be conservative, and if you're wrong, you should be wrong to the upside, not to the downside.
Right.
So I think the challenge that many of our borrowers have is that we went through this very strong and fast upcycle where in 1 year you may have been looking at rents for a 2-bedroom at $2,200, and then the next year it was $2,800, and the next year was $3,400, and they're just assuming that next year it's going to be $4,100. And we say, no, assume it's going to be what last year's rent was. Does the deal still make sense? I recall one instance where a client came to us, and he came to us before he actually entered into the hard contract stage, and we underwrote, and we came back to him, and we said, we don't think it's a good deal for you. We're not going to do the deal, but more importantly, we don't think it's a good deal for you. And he actually walked away from it, and he came back to us later, and he thanked us for it. And he said, that's real value that you provided for us as borrowers, is that we're looking out to make sure that they're going to make money at the end of the day. Because our objective is everybody's got their piece of the pie, but everybody's got to have a piece of the pie.
Now, the truth is your answer really enclosed everything, but this maybe a final good business takeaway.
A good business takeaway.
Yeah, again, it's such a wide open question. But
I think the best advice I can give is that the steady, slow, conservative approach will ultimately be the safest one. That having been said, many of my clients are the fast and aggressive type, and kudos to them because they've pulled it off.
I love the honor of interviewing C-level executives and sharing their great advice and perspective on Mind Your Business. I'd love to get your feedback. Post it in the comments below and subscribe. You'll never miss an edition of Mind Your Business.